So our next guest oversees now more than $260 billion in assets under management. Private equity firm EQT is hosting its first ever U.S. capital markets event right here in New York City later today to mark 5 years since the firm went public in Stockholm. Join us right now first on CNBC is EQT Managing Partner and CEO Christian Sinding. Good morning to you.
Good morning.
Congratulations. It feels like it's necessary for 5 years rolling here. I don't know if you saw us a little bit earlier, but we were talking about Larry Fink, who came out and was saying actually that we should not be worried about the elections. We should not necessarily be worried about some of these sort of broader things. I don't know if he was saying geopolitical issues writ large, but you seem to be on the other end of that. I think you think that geopolitical issues right now are super important.
Yes, they are important. And if you look at what we're discussing in our investment committees these days versus maybe 10 years ago, geopolitics, global security, societal change, we discuss a lot of those themes. But when you break it down into what we're investing in, then I'm kind of in the same camp. We're actually not that worried. We're still deploying quite a lot of capital in themes that we're investing behind. And we have a fundamentally positive outlook on where the world is going long term. Yeah.
Do you have a view? I mean, we've also talked about the prospect that former President Trump might become the president again, and he wants to implement tariffs. When you start to look at your portfolio companies and the companies you may want to buy or not, does that impact the way you think you'll think about that in the future?
I think you have to understand the policies of the largest country in the world and the largest economy in the world, and think about how that might impact business. But what we're investing behind are kind of long-term secular themes in society. We're looking at the digitalization of society. We're looking at the climate transition, helping to drive that. Aging population, health and well-being, live experiences. And if you think about those themes, they're not necessarily impacted that much by global trade. Another way to say it is that we try to stay away from commodity businesses. We try to stay away from heavy industry, cyclical businesses, and rather invest in where the world is going.
In the construct of just where we are in the cycle, do you say to yourself you are in a buying mode because things are cheap, or this is a harvesting mode because things are expensive?
Right now, you never know if you're buying cheap, actually, in our business. But you can know if you're selling well. You can measure your returns. You know what your targets are. If you have 2.5 times the money or whatever in a deal. So we're actually doing both right now. I mean, where we are in the private equity cycle is that we've all invested quite a lot over the last 5-7 years. We haven't sold enough. So the main focus today is exits. It's exits, exits, exits.
Well, I was going to ask you about the exits. Part of the reason people need the exits is because there's nobody to provide funds anymore. I mean, it used to be you'd go to the U.S. pension funds and get money. They're tapped out because they haven't got any money back. Then everybody went to the Middle East. Now it appears the folks in the Middle East actually just want to invest in the Middle East. They don't, right? So they're done. So where is the capital going to come from?
Yeah. Well, there are two sources of capital coming into private markets in the future. First of all, global pension funds, sovereign wealth funds, institutional investors will continue to invest in our industry. So it's growing at like 5, 7, 8%, something like that. Then private wealth is, of course, the big theme. And now, we and some of our peers are large enough to create products for that channel.
In a sort of retail-esque way.
There are trillions of dollars that should be invested in private markets and generate the returns that we help create.
So what has to happen for that market to really move?
It's starting to move now. And what's interesting is that in the past, we haven't had the breadth of products, the liquidity in the business to actually provide retail types of products. Now, retail products need monthly pricing or maybe weekly pricing. It needs monthly liquidity. That hasn't been possible in the past. So it's product development and size. So we can do that now. And on the other hand, you have deregulation, actually. So in the US, in Europe, in Asia, the regulators are actually working with us to make our products available to the everyday saver. And I think that's great.
When it comes to private markets, we saw in the last year and a half, and we use the B-REIT as an example of this, but there have been times when these products, for retail products, haven't allowed you out, if you will. And so the question is, if you actually really got into it, I mean, that was just one example of it. Starwood had another example, that was in the real estate space. But if you had enough of these situations and the market really turned the wrong way, do you think that the market could survive?
I think so. I think because it actually, these products have now been tested over a cycle, and it worked. And what you have to understand, the premium returns that are generated in our industry, part of that is because it's not as liquid as public markets. So a typical investor today, a typical retail investor has maybe 0 or 1 or 2 or 3% in private markets. We think it should be something like 15 or 20. But the rest of your portfolio should be more liquid. So it's not going to be that your entire portfolio is invested in liquidity. Is that because
people aren't marking it? Because it's not marked on a daily basis for real. Is that why structurally that can work out?
Well, structurally, if you think about it, it's pretty. We own companies and buildings, basically, right? And you can't you can't create liquidity in a company overnight. So the underlying liquidity in the funds has some limitations, and therefore, to get that premium return that we're generating, we need a bit of illiquidity in the system, right. And therefore investors have to find that balance. But today they're massively underinvested, and so the growth opportunity is very large, and we look forward to exploiting that.